Hello. Good afternoon. Can I have your attention, please? Okay, we are getting ready to get started. And I'm super thrilled about our session today. We still have some folks trickling in, so they'll be coming in these side doors. Hopefully they won't distract us too much. And I know we have a great online presence as well. So really looking forward to today's topic. So real quick, I'm going to go ahead and make some introductions of our panel discussion today. We have Dean Rosenkrantz. Wave, everybody, Dean. Hi. Okay, Dean is a 25-year commercial banking veteran with the last 17 years serving Texas businesses. In 2019, he founded the Dallas Bankers Club, and in 2021, the Houston Bankers Club, both private member social clubs for senior commercial bankers and executives. The Dallas Bankers Club and the Houston Bankers Club presently have over 500 members and meet 6 times per year in a social venue to collaborate, network, and raise money for various not-for-profits. The club hosts an annual gala benefiting local charities while honoring local bank legends whom have helped shape the local communities by which they serve. Dean has been on the advisory board member 2021 for Dallas Summer Musicals, emphasizing education and access to the arts for underserved communities. He is the founder and co-founder of Advanced Community Fund, a certified development financial institution for making loans to low to moderate income communities. Okay, next is, let's see, let me go in, there we go. David Knockley. David? Everybody? That's David, y'all. David Knockley is a Vice President Relationship Manager for the corporate banking team at Bank of Texas. He is a strategic consultant to clients and focuses on various industries, including manufacturing, distribution, service, healthcare services, public and private educational institutions, financial services, and technology. Prior to joining Bank of Texas, Knockley began his career at Bank of America Merrill Lynch, completed their formal credit training program, and then joined the business banking team as a client manager. He also served as a commercial underwriter for BB&T and middle market portfolio manager for Veritex Community Bank. Actively involved in the community, Knockley has volunteered for Junior Achievement, United Way, Habitat for Humanity, March of Dimes, and the American Heart Association. Knockley earned his Bachelor's of Science in Finance from the University of Texas at Dallas and was a member of the National Dean's List. Okay, next on stage, we have Rachel Capps. There we go. Rachel Capps is a Senior Vice President at Capital One Commercial Banking, covering the C&I and Dealer Services segment for North Texas. Rachel has more than 20 years of experience working with privately held and private equity-backed clients, delivering commercial banking and advisory services. She is an experienced provider in asset-based and cash flow lending to support mergers and acquisitions, dividends, partner buyouts, expansions, and working capital, as well as cash management and risk management solutions. Rachel is a member of the Executive Women's Roundtable, a graduate of the Leadership Dallas class of 2021, and was recently named an Outstanding Director Award by the Dallas Business Journal. Earlier in her career, she completed a formal credit management training program of a top 5 U.S. bank, graduating top 10% of her class. She holds BBA degrees in finance and marketing from the University of Oklahoma and is an alumnus of Ursuline Academy of Dallas. And, uh-oh.
Already starting.
And last but certainly not least, Mark Farmer joined UMB in January of 2017 as Senior Vice President of Commercial Banking in Dallas, Texas. In this role, he is responsible for promoting the bank by building strong business relationships in the Texas market while bringing a unique value proposition to his clients through creative and flexible credit structures, strategic insights, and unparalleled service. Mark is directly responsible for all credit and core banking needs while orchestrating other areas of the bank to meet client needs. Industry specialties include manufacturing, distribution, service companies, and private equity/family office portfolio companies. Lending specialties include the full spectrum of borrowing from asset-based lending to cash flow lending. He has 16 years of commercial banking experience and 29 years of business acumen to rely on when developing customized financing solutions with his clients. Mark earned a Bachelor's of Science degree with an emphasis in finance from University of Texas, Dallas. Mark has been involved with organizations such as March of Dimes, American Heart Association, United Way, St. Jude, ACG Dallas, Financial Peace University, and his local church. Please help me in welcoming our distinguished panel today. And with that, Dean, I'm going to turn it over to you.
Thank you, Jay. I appreciate it, and welcome everybody. Thank you to our panelists for being here, and we look forward to having a great discussion about what really we've experienced in the last 18 to 24 months as bankers. So as bankers going into the crisis, we were worried about our client, as so many often run on thinner cash cushions. Pre-COVID, according to the Federal Reserve, many companies said they would use cash reserves to fund a 2-month revenue loss. More said they would use personal funds, lay off employees, take out debt, or downsize operations. Based on reports from bankers around the country and economic data, it is a resounding yes that the public bridge throughout the crisis was a success. Rachel, what can bankers do to help ensure all business owners are supported during the bounce back?
I think for us as bankers, the most important thing that we can provide to our clients is information. We have access to information just because of the depth of our institutions and the diversity in our customer base, that we get visibility into a lot of different companies and a lot of different challenges and perspectives and thought leadership. And it's really important that we make sure that we communicate that to our clients. We're not here to tell them what to do. We're here to be their advisor, and part of being that advisor is giving them information so that they can make an informed decision to manage their business. And so for me personally, what I really try to do is I make sure that I'm being candid with them, that I'm communicating with them frequently, and most importantly, I'm doing it in a timely manner so that they can make the best decision for their business.
Absolutely. Mark, what are you seeing?
Yeah, so I would agree with that. I would say at the end of the day, you know, you hear terms like banker and lender used interchangeably, but I think they're not, right? So we're not lenders, we're bankers. And so how do we help your client? It goes back to that 101 of banking, of kind of 3 kind of core things that I think about, which is 1, communication is key. You've got to have an ongoing dialogue with your client. You've got to know what's going on, and they have to trust you. If they share maybe an upcoming possibility of something, you know, materializing that might be negative, that you will handle that appropriately within the bank and be an advocate for them. So having that ongoing communication is key. Then just, you know, you get to know a new client up front, right? Customers want to know that you understand their business, right? So that shouldn't stop after a new relationship starts. It should be ongoing. So something as simple as joint quarterly reviews of financial statements, getting together, sitting down, even if everything's great, just talking about what's happened over the last quarter, what you're looking at for the next quarter, and just keeping that dialogue going. And then lastly, I always like to dig into what else do you need, right? So yes, I'm a banker, but there's other business needs that you know, and I know all 3 of us, we spend a lot of time knowing people out in the market that we can bring to the table for our clients. So any business need that you might need as a business owner or a CFO, one of us ought to be able to bring somebody to the table for you that's not just somebody we met yesterday, but somebody that's been vetted over time.
David?
Not much I can add to that, but my spin on that, quite frankly, is just talking with my clients, my prospects, with just an open ear, right? Being the listener. I think a lot of times people go into, especially the lenders, as Mark referred to, they go in looking to sell something immediately. And that's something that I think all 3 of us tried not to do. And it's listening to what your needs are, how your business is operating. Because as Mark said, and I'll reiterate it, is we are your advocate inside the bank. When there's an opportunity for you guys, whether it's whatever that need may be, we have to know the story well enough that we can engage with our credit officers and the higher execs to tell the story, tell it well, and make sure to move the process forward. So all of that, quite frankly, takes a lot of time and development of the relationship, and we have to keep just an open ear.
Very good, thank you. So why don't we go to a poll question. Mr. AV guy or Nancy. So for here in the room, have you experienced an increase in cybersecurity risk during COVID-19? Actual business ransomware loss or hacking of the business of personal accounts? By show of hands, has anybody had a cybersecurity loss? We have one here, two. So we've been fortunate in this room to not have had much cybersecurity losses. That's great. As far as the poll, can we see that on the screen?
Looks like 37.
37% have had a hacking or on their personal accounts, and a majority have not had a loss. That's really good. I think that's a testament to some of our risk, our CFOs here in this room who have risk under their moniker as well. So as we discuss what we've learned during COVID, hopefully some of the takeaways from this panel discussion will illustrate how the banking industry is poised to assist companies as we come out of the pandemic crisis. You know, a lot of bankers I've talked to think that have been a few game changers during this crisis, and that is these have put somewhat of a bookend on the distress of the pandemic, and that owners and sponsors can see that distressed companies and distressed assets may only need a bridge, a loan, like the PPP, versus a sale or closure of their companies. Certainly, during the beginning stages of the crisis, a plan to bridge companies was the immediate game changer. I think we would all agree that the PPP program was something that was definitely needed during this time. According to the SBA, about 77% of small and medium-sized businesses received a PPP loan. And in 2020, 86% of those owners have submitted a PPP forgiveness application for their 2020 loan. As of July 21st, the SBA and lenders have worked to originate over 11.7 million loans totaling nearly $800 billion in relief to over 8.5 million businesses. Let's dive into the PPP and what you and your institutions experienced during this time. David, I'm interested to hear what Bank of Texas did during this time and what you experienced as a banker. I know we all experienced a certain level of stress, but give us some perspective as to what your institution did, and we'll kind of work down the line and hear what the others have done as well.
Thanks. Yeah, PPP, just like it was interesting for everyone else in the room, it was certainly interesting for us on our end. As the news reports came down, everyone had heard about the programs, and it seemed like everyone said, call your banker, they'll know the answer. And quite frankly, no one knew the answer, because I was reading the same articles you were and the same legislation that you were, and it was mayhem to say the least. However, it was, I think we all got through it really well. So for Bank of Texas, we actually started this process in November/December of 2019. If you recall, the discussions of COVID first started, and it was all in Wuhan, right? And a lot of our clients manufacture a lot of things in China. And so the first thing that we did from a credit risk perspective was trying to figure out who in our portfolio could be affected by supply chain issues. Ring a bell? Full circle here. But we started reaching out to our clients and saying, hey, are you manufacturing products in China? If you are you having any issues with the production, getting them over to states, et cetera? And so as we moved on, you know, everybody seemed to be in a pretty good space. And then of course, we all remember March of 2020, we all went home and stayed there for quite some time. And then towards the end of March of 2020 is when the news of PPP came out, and Bank of Texas had about 5 to 7 SBA folks, and they were the ones that were tearing through all of the information and trying to prop up a process for us to process all of our loans. And so that beginning part of March was just, or that end of March was honestly just trying to field all of the questions from all of my clients, trying to assure them that we knew what was going on to the best of our ability, and that they were going to be the first applicant in line. I think everyone in the room was probably scared because it was the race to the bottom of the barrel. And so given that we were kind of the middleman, if you will, it was really important for me to just give as much information as I could, but also give clarity to say, hey, we're gonna process your application as soon as possible. When it opens up on Friday, don't worry about it. So fast forward, May or April 3rd, I think was the beginning day. It was on that Friday, and I was getting blasted with emails. Everyone was sending me their applications. What does this look like? How is this payroll? Does this look okay? What about this? And so for the first 2 weeks, probably through mid-April, there were a lot of late nights helping out not only my clients, but others within our institution, just trying to process that information and work the process that we had internally. It was a little bumpy at times, but quite frankly, I thoroughly enjoy my job, but I felt like going through the entire PPP process was probably one of the most meaningful things that I'd done in my career. Distribute those funds, so.
Absolutely. Rachel, what did you experience at Capital One?
Oh, I'll give you the woman's perspective. So going back to March of 2020, first week in March, I'd actually spoken at a career fair at Ursuline, and I think it was a Thursday I did that. On Friday morning, we got an email and said, thank you to everybody that came in and spoke. We've just been notified that one of our students' parents had tested positive, and we just want to make sure that we are communicating that with you. So, I got the pleasure of packing up my office real quick and going home to quarantine for 10 days. About a week later, we were watching all the news, more and more stuff was starting to come out about all these cases, and we started to see companies start to shut down. So we got the notification that our office was shutting down and that everybody was going home. I was already at home anyway, so there wasn't really anything for me. The following week was spring break. I have 2 girls in elementary school at the time. And as things are shutting down, I'm like, there's no way they're going back to school. There is no way. And sure enough, at the end of spring break, we got notification that school was not coming back. So you could feel the world closing in, as we're working from home. Meanwhile, I still have a job to do. My husband is also in financial services, so he was about a week and a half behind me. My office shut down first, his office shut down second, and so there we found ourselves with 2 parents working from home and 2 kids that are at home, and I was now the primary caregiver. I'm also the school teacher, and I also have a full-time job that I have to work. So it was a little bit of child neglect in my home, I would say. We got a lot of screen time, but I did enjoy having everybody home and during that. So as this is coming down, for those of us that worked in the financial crisis, we knew this is bad. This is really bad. And God, I hope I have a job next month. That was probably the first thoughts that were running through our head. My husband and I are working at different institutions, but I was like, man, we have never seen it just grind to a halt the way it did. And so I was like, well, hopefully one of us will survive. That was our hope, please. Then we got the notification about PPP was going to be rolling out. So, Capital One, I would not say is a huge SBA platform. We do some SBA loans, but that's definitely not our area of expertise. And so they sent notification out to all the different lines of business. Capital One did, and said, we're rolling out this program. We're going to be doing it next week, and we need volunteers. Please raise your hand if you're willing to help. So, I wanted to make sure that I'm providing my value to the institution. I would like to keep my job. Of course, I raised my hand. They said, okay, we're doing a training. So Saturday morning, we got up, we did a 3-hour training via Zoom, and then we were ready for Monday morning for the floodgates to open, and everybody got pulled from any line of business within the institution, and then they were allocated to their job. So we had some people that were intake, we had some that were processors, we had some that were underwriters, we had some that were approvers, and you had your allocated job. And then when the applications were open. You basically got online, and I was front lines processing applications. And so we would get up at 6 o'clock in the morning, or as fast as you could get up. And when I was on that computer and I was working, and we would do that until 2 or 3 o'clock in the morning, because like David said, we knew it was a finite resource and it was a race to the bottom, and we wanted to get that money to our clients so bad. So how much, if you can stay up 1 more hour to process loans, do it. So it was very intense. Meanwhile, my kids were living their best life with their iPads.
Have them
Don't go out.
processing loans?
Probably ate terrible food, I'm sure, but it is what it is. They're still alive. So that was sort of our experience, but it was also, as David said, very rewarding, because it was very scary when you go back and you're like, we don't know what this looks like, but we knew we wanted to help our companies survive. And I think what was so hard about the pandemic was that there was nobody at fault. There was nobody to say you did something wrong. This was completely faultless, but yet you felt helpless. And I just, when I look back at my time doing that, you know, like I could do something, I could help. And that was really what we enjoyed, is that I literally was going through the applications and helping clients and helping people. And that when we got to the other side of it, you're gonna say, you know what, I'm just a small little nugget, but I was at least part of the process that helped.
So, Mark?
So I'll be brief, since these two did a great job in explaining, but it was, you know, COVID was surreal. But watching PPP unfold on TV versus the reality on the ground was like wondering what planet you lived on compared to the people on TV. You know, you had Treasury Secretary, you had politicians on TV. Hey, you know, walk into your local branch, although you can't because of COVID, and show them your payroll, and you'll walk out with a PPP loan. It's like, and so customers were seeing this on TV. You know, people were calling. People from other banks were calling. Hey, are you doing PPP loans? But there was this whole process of the law was done. Then the Treasury website had these, what they thought was going to happen on their website, and people said, oh, it's the Treasury, that's the deal, right? But then people didn't realize, well, now the SBA has to figure out how to do all of that. And we had to wait on the SBA to figure out how to do all that so they could tell us what they needed from us. So there's this whole kind of downhill, you know, to the banks, and all along the way, things were changing all the time. You know, the rules were changing, and it felt a lot like, you know, I mentioned this a few times with some clients. Say, okay, now you kind of know what it was like when the whole TARP scenario back in the days were, okay, do this, and we'll figure out the details later. That's kind of how PPP rolled out, and you know, it was a good program. At the end of the day, there was no way to, you know, I can get in offline. I can talk about the whole needs-based thing versus not, because that's a whole bag of worms too. But you know, it's one of these things where UMB, $34 billion bank, and we've been around for the whole 100+ years thing, but most of that growth has been over the last 10 to 15 years. So the good thing about that is we were still really good at doing a lot of things manually. So we were ready to start processing PPP loans the day that we could, and we started to, and we had people just like Rachel, David, burning the midnight oil 24 hours a day, working these things until we had a platform up and running that kind of helped smooth things out. But we never stopped, and I think we got every client of ours that wanted and applied for a PPP loan in the round one of funding, got it in the round one of funding. And so we were really proud of that fact. Anyways, I think that's all I have to say about that.
Good,
Yeah.
thank you. So why don't we do another poll question? So for those in the room and those online, is there a difference in your current business recovery versus what you may have experienced in prior cycles? Is it a V-shaped recovery? Those in the audience? Is it a flat to steady recovery? No recovery experience just yet. What have you experienced? V shape? Not a V? More of an up and down? Yeah. Up. Looks like it didn't get up there, so.
There we go.
30% V, 58%?
Is that 56% is a flat trajectory?
Mm-hmm.
Well, at least there's a very small that haven't experienced anything yet, so that's good. All right, so according to the NFIB survey, 21% of owners report that economic conditions are back to normal now in their area. Another 6% of owners anticipated taking until the second half of 2021, and 23% anticipate sometime in 2022 before economic conditions return to pre-COVID levels. And 28% of small businesses are less optimistic and expect conditions not to fully improve until the second half of 2022 or even 2023. Looking at your portfolio of clients, what percentage of those that receive PPP funded or funds benefited and are still in business? What are your clients saying to you? Are banks seeing the bounce back? Are your clients, what are your clients talking about right now? So Mark, why don't you give us some color on your clients and what they're saying to you now?
Sure. I don't think we had any clients, at least yet, go out of business. We've had, and most of them had recovery. A lot of them, because we're not doing a lot in the retail space, the hospitality space, a little in the energy sector, but not a lot. So none of the sectors that really got hit, we weren't involved with. So a lot of our clients were either kind of the flat or had that 2-3 month dip where everybody was kind of wait and see, and then they kind of either got back to normal, or I had a few that really just took off, and it was a boon for them. And then there's a few that are still struggling. A lot of those are the ones that maybe they sell or they distribute a product or manufacture a product that has microchips in it, and that just continues to be an ongoing thing for it. But as far as what are the clients talking about, I don't think any of these are going to be a surprise to you. Number one is supply chain. Those, as I mentioned, those with chips in their products are having a problem. Anything that's coming overseas and they didn't already have a big backstock on, are having issues with supply. Not with demand, just with supply. And then, the second one is kind of two-part, finding people to work in manual jobs. So those same sectors, manufacturing, distributing, anything where we've got a workforce, labor force, people just they don't want to work, or they don't want to come back to work, right? They've been used to just sitting at home and getting a check, or it's not a big enough of a variable. Okay, I'm going to make a couple $100 more a week going to work for 40 hours versus stay home. I'll just stay home and live on a little bit less than before. And then the other part of that is also, now that we've kind of seen kind of a swing with the vaccine and everything, is office people. They don't want to. A lot of office people don't want to go back to work. They've gotten used to working from home and not having to get up and take a shower, or whatever they needed to do, drive through traffic. And they've gotten used to it, and they're really fighting a lot of places going back into the office. And then, of course, everybody's talking about the vaccine and politics and things like that in the news. I won't get into any of that here, but how about you guys?
So David, a lot of people have turned their sights to growth.
Yeah.
As far as a mindset versus maybe a defensive posture. Are your clients experiencing somewhat the same thing?
Absolutely. Yeah. I'm in a little bit of a unique situation. So I joined Bank of Texas in May of 19. So as you can imagine, I was meeting all of my clients right before everything, quite frankly, just stopped. And so the whole PPP process allowed me to gain rapport very quickly with those clients. And so for me, it was very unique, and it helped me. But my clients, to Mark's point, I had one that was in the energy sector. They supply water to drill sites, and if you can imagine, remember in March, the futures for oil were negative some ridiculous amount. I forget how far it dropped, but their business shut down. And so to your question of did the PPP funds help, it literally kept their doors open. It literally kept their employees paid. Now the owner came out of pocket some, and that business applied for both rounds of funds, but for sure it helped move them forward, no question asked. That owner also owns a technology company, a telehealth business. And if you can imagine, when all of this happened, it was just the complete opposite. They couldn't keep up. So yes, the funds that they received from PPP helped pay their payroll, but every single extra dollar that they were earning, they were putting right back into the business to keep it growing because they couldn't keep up. And so it was a very interesting time, and it still is. I have clients that are just seeing massive growth, not only in top line revenues just because of price increases, but also just in volume in general. And so I think it's partly because of the PPP funds, right? Getting so much liquidity out there, people are still out there working and doing business. But I also think the other part of it is we're in a great marketplace. Dallas-Fort Worth is insane as far as how many jobs there are, how much work needs to be done. And, so absolutely the PPP funds were a great success for my clients. And to Mark's point, I mean, what I'm hearing from my clients now is it's the same thing. It's supply chain issues. I'm having issues trying to source X, Y, or Z component. I've had to, go to the secondary markets, and I'm paying an increased price, and so margins are holding steady. I talked to a client this morning actually, and his margins year over year are just about flat. And I said, "How are you doing that?" He said, "Well, I'm marking up the price of all of my inventory. Now I don't know what's going to happen when prices actually start to go back down." Mm-hmm. So, but the reality is everyone's keeping up. Everyone's trying to figure out how do we deal with the inflationary prices, especially some of those that deal with commodities. I have a couple of clients that deal with steel, and so they're seeing, in one instance, they're seeing 600% increases in the inputs. And so just trying to keep up with that working capital need. And then also to Mark's point, politics.
So Rachel, with Capital One really being a technology bank, really, I mean, if you really were to peel back the onion and all the technology that they have backing their clients, have you been able to, or have you noticed some of your clients pivoting technologically wise to keep up with their business? Or I would think that a lot of our businesses have pivoted during this time and have kept their doors open because of technology, and the banks have had to kind of step in and help with some of that.
Absolutely. You speak to Capital One being a technology company, and we absolutely view ourselves as a technology company that happens to be a bank. One of the things that we did pre-COVID was that we were moving to the cloud. And so before March hit, we were almost 95% on the cloud. Anybody that's been in banking, you know that banking is founded on archaic systems. As an ancient industry, we also have ancient infrastructure. So every bank, if you read any of their reports, they're all looking at kind of this technology migration. And one of the good things that I think we're very thankful for, especially for us at Capital One, is that we were probably light years ahead of that in moving to the cloud. And then when COVID happened, it definitely helped us pivot to when we went from a work from home environment. Ironically, I'm still working from home. So we were supposed to return to the office in November, and we just received notification this past week that we are pushing that out. So I will continue working from home, and probably will be working from home until 2022. But I am one of those probably anomalies in the market that I thoroughly enjoy working from home. So I don't know, perhaps it's the female-male perspective. From our customers, it absolutely accelerated their technological advancement. Whether it was moving into, if they worked from a remote environment and kind of embracing that, or we kind of talked about a lot of these headwinds that our companies are experiencing now. You had to embrace technology in order to be more efficient and to work in this unprecedented time. But I think it also really gave us and gave companies really good perspective. I think everybody has learned that we don't need the traditional office environment to work. And while there's different points of view of the pros and cons of both, and I agree with all of them, I think technology has really enabled us to be an ecosystem that can survive without the traditional brick and mortar work environment, which I think has been really nice. You know, kind of circling back to the PPP funds and my client base, it was a huge success. I'm happy to say that I had none of my companies that defaulted or closed shop as a result of the pandemic. However, when you look at the portfolio, there definitely were kind of those that were more heavily impacted versus those that were least impacted or maybe even benefited, sort of like the telehealth company. We saw that a lot. We've got a pretty robust food and beverage platform. And so, you know, those that are in the quick service restaurant industry, they've actually had record year. Same with the auto industry. You know, when you look back at the financial crisis, one of the big concerns, they were hit extremely hard back then. And that was one of our first concerns, was the portfolio there. And they've, because of the dynamics going on, are doing remarkably well. Who would have thought that you ever pay more than MSRP for your car? I mean, it's crazy, but that is the world that we live in. And I think what we've kind of seeing and that we're continue to see is that we have, where you, regardless of where you want to say we're in this pandemic or out of this pandemic or whatnot, we have so much disruption in the market, and there's so much still going on with our clients, whether it's from the chip shortage, wage inflation, employees, whatever it is. Almost every single industry, I think, can say is experiencing some sort of disruption. And I think when we kind of look back and do some analysis, I don't know if there's ever going to be a point in time where we're going to say, I have never experienced so much disruption so fast, but I survived. And I think that's a really good story.
Absolutely. So why don't we do another poll question? So for those in the audience, do you plan on making extensive capital outlays and hire more employees in the next 6 to 12 months? Yes or no? Those that are yes. So those that are on the web, it's a resounding. A lot of companies here in the audience are expanding. And for those in the poll questions, we'll give it a few seconds to repopulate. So 51% say yes, 27 or 37% say no. And there's certainly some uncertainty right now as well. Hopefully that doesn't break anything. So we're going to get into some discussion here. As you know, I think a lot of people are interested as bankers what we see in the credit environments. You know, a lot of our clients are coming to us asking for increases on their lines to overcome certain working capital needs. But, you know, in conjunction with the programs that we've talked about, the government allowed us banks to defer payments, do loan modifications, and allowed the banks to not have to classify as troubled debt restructuring. The government did so much right to give us the ability to service our client needs. Loan programs aside, what lessons have we learned during this time? Was there a difference in the pandemic versus the financial crisis? And do banks look at the standard credit metrics the same going forward? So Rachel, back to you. What are you seeing as far as your credit culture? I mean, we're all have different credit cultures at every bank, but at the crux of it, we often have a lot of similarities. But at Capital One, give us some perspective as how you're going to look at things going forward, possibly.
Sure. You know, we really pride ourselves on our credit and diving deep into our clients. So as we are starting to look at credit requests that come in, there's sort of two different approaches on how we do that. Traditionally, in bank underwriting, you're going to be evaluating your current year and how you did compared to the prior year comparison. Well, and this time, that's not really a very good baseline because we all know what happened. So, you know, a lot of the things that we're looking at now, we really are going back and comparing it to 2019. So how are we doing in the current year period versus 2019? I would say that sort of approach is for those companies that we would say are on that steady incline or have somewhat recovered, mostly recovered out of the pandemic. If we have some companies that are impacted, and we still have some in the portfolio, especially those that are on the experiential side, you know, they still are not back to normal operations. So when we look at things, we're probably looking at a shorter time frame, and we're doing a quarter over quarter or a month over month, and we really have to see what they're doing on a much smaller time frame versus what we did on a year over year basis. Conversely, we have some of those companies where they have benefited from COVID. And so when we're looking at those companies, we're almost sensitizing down and saying, you know, we've got record profits, but this is not normal, and we have to underwrite to a normalized environment. And so we're purposely bringing stuff down because we know that the dynamics is creating sort of an abnormality. Although it's in the company's benefit, we know that, you know, we underwrite to the long term, and we know that this isn't a long-term play. Eventually, it will start to normalize. Now, if you can tell me when that would be wonderful. But until then, we just have to do our best guess and make sure that we're being prudent when we're working with our clients.
Right. David, how about you? What is Bank of Texas looking at as far as some of these, the ghost year of 2020 and 2021 possibly?
Yeah, it's a great question. And honestly, I can't add too much more than what Rachel said, but Bank of Texas, we pride ourselves on being a diligent underwriter, so very similar to what you were just talking about in Capital One. We stick very closely to our policy and what we believe to be a good borrower. And so a lot of those are similar metrics that everyone looks at within the banking industry. And so just like what you were saying is we have those like the QSR space, the restaurants, absolutely just, I mean, 2020 was a great year for them. It was insane how much year over year growth they had. But going forward or looking at new deals, we can't look at leverage ratios the same and say, okay, well, I'm going to leverage up, you know, this to a 6 times multiple. So we're looking back and saying, okay, what's normal and how long will it take to look forward and back to normalize? And so it's a lot of diligence. It's a lot of digging in. And just like what you were saying, the ones that were hit hard and are still working through it, we are looking at a much shorter time frame, and we are looking at quarter over quarter analysis, and then also the same quarter over quarter into the previous year too. So it takes a lot of work, but going back to our first question, that's really our jobs. We have to know that story. So when we're out there meeting you as a client or a prospect, we have to know that story. And we have to dig in just as much as you guys do on a daily basis so that we can internalize that and then take it back to our credit shop so we can make sure that everyone inside of our institution understands that story.
So Mark, is UMB, or I'm just curious, when you see all that cash on balance sheets nowadays, what do you look at that as, well, it's a good thing, or obviously it is a good thing having a lot of cash on the balance sheet, but it's an anomaly in some cases?
Yeah, well, so you typically, with all the liquidity in the market, you know, what happens is you've got working capital and you don't end up with a bunch of cash on the balance sheet. You end up with no cash and no loans because they pay them down. Yeah. And so that's been, you know, that coupled with, you know, the low interest rate environment, you know, has been a, you know, big hit on banks. You know, from on the question on credit metrics, the only thing I would add there is, you know, I agree. We're all the banks are just taking a look at 2020 and kind of Xing that out and say, I'm not going to look at that. I'm going to look at before and now. But then there's also the other thing that I'm looking at, or we're looking at UMB, is projections, right? And are these projections CFOs, or are these dreamjections, right? So honestly, you're better off if I see something that looks like a dreamjection, I'll say, you know what? Is this really what you think, or is this what you hope is going to happen, or your best case scenario? If it is, great. But I would say if it just looks unbelievable optically, let's pare it down a little bit. It still works, and then you exceed our expectations for next year. It's a win-win. So there's some conversations like that happen. One of the questions, Dean, that I want to touch on was the difference between the last financial
Pandemic versus financial
the
crisis.
pandemic versus the financial crisis is, we were kind of talking about this beforehand. They're kind of different sides of the same coin, right? So the financial crisis was the financial institutions themselves causing a problem in the rest of the, so it was internal to the system, right? The COVID and the pandemic was external to the system, and then this time the banks were actually there to prop up and help and be part of the solution. It's the whole PPP is the business side of the TARP, right? Kind of back, two sides of the same coin, but all kind of one system from a financial perspective.
Well, let's do another poll question. And this is a very basic one. Did PPP make a difference in your business? By show of hands in this room. So yes, I would say a resounding yes. It helped a number of businesses here in this room. And
I spent a lot of hours. I better see more hands.
That's right.
That's funny.
Wow. That's interesting poll there. So I know that there's about 100 on the call. So that to me surprises me, but 40, what does that say? 49% a yes and 51% no. All right, well, so as bankers, I think we find ourselves in a unique position to assist our clients with growth. From my discussions with my clients and bankers of the Dallas Bankers Club and now of the Houston Bankers Club, we are at record levels of optimism. For the banking industry, the middle market composes of $6 trillion of GDP and 45 million jobs, which is a huge component of what we do as middle market bankers. Historically, where banks have played is in working capital finance. Are you seeing an increased need for working capital to assist you with the restocking of inventory? Get ahead of supply chain issues. We talked a lot about supply chain. I think that's the biggest thing that we have to face right now is restocking and supply chain. So David, give us some perspective on what you're seeing with your clients. I think you've already touched on the supply chain, but different things for working capital from your clients. What are they asking for nowadays?
So absolutely. I just went through, I think it's been 3 underwritings now for increases on working lines of credit for this exact purpose. So one of them is a structural steel company, and like I said earlier, they've seen 600% increases on a component that they put in. It's the roofing part of it, believe it or not, and they're projected. I just signed the loan docs with the borrower. I think it was Thursday, and he said that they're projected to quadruple revenue. So they're about $100 to $115 million business year in and year out. I mean, almost every single year. And he came into my office the other day and he was signing the documents and he said, yeah, I think earlier in the year we were talking about 200 million. Well, he tells me now it's going to be 400 million. So we just took his line of credit from 5 million to 20, and it's this exact need. He's got a strong balance sheet, but in order for him to work through all of these projects, he has to have a working line of credit to get through that. Another general contractor, honestly, is just seeing so much business in general in the Dallas marketplace that they're billing record months. They've never billed $10 million in a month. And so to pay their employees on a weekly basis, they're seeing their cash balances start to dwindle down really close to zero and starting to rely heavily on that line of credit to keep them through those cash crunches. So I've seen a lot of increases in working capital needs, both from, like I said earlier, just sheer volume of work and also from inflationary prices.
Sure. Rachel, what are you seeing? I would think that with some of the treasury management products that we all have, you're probably getting a lot of questions from, how do I increase my DSO and improve my DPO and all that other fun stuff? So what are you seeing with those types of questions?
Yeah, so I'll give you a little bit of a different perspective, being that I cover dealer services. They're sort of having the opposite problem that David is having, in that because of the microchip shortage, they don't have vehicles, and it's kind of scary. It still feels a little bit like Armageddon when you drive past these huge dealer lots and they literally don't have cars. So they would love to have inventory. I would love to finance it for them, but we're in this crazy time right now where they literally don't have inventory to finance. And so on our dealer services portfolio across the company, our outstandings are about down 60% of where they normally are, just because they don't have the inventory for the floor plan lines, which is the majority of the type of financing that we do on the dealer side. One thing we haven't touched on, which I think there's a huge demand in the market that we're seeing a lot for, is M&A. So not only are people experiencing robust growth, but the M&A market is on steroids. We're on pace to have a record M&A year. There's been more M&A transactions this year than any other year previously. And it's not necessarily companies are selling because they're struggling. We still have so much liquidity in the market that valuations are still astronomically high. And so you still have a lot of this M&A activity going on. So a lot of the things that I've seen this year is that we've been doing a lot of M&A financing, and it is rampant in every single industry, no matter what it is: manufacturing, technology, healthcare, auto. It is everywhere, and we are doing a lot of it.
So Mark, I'm curious with UMB. I know with my institution and what some of my clients have approached me about is the fact that they don't have enough space to basically bring the inventory in for restocking what they're trying to accomplish for their growth. Are you seeing an uptick in real estate as well? Yeah. Owner occupied?
No, I'm not seeing. Shelves are still empty. I do a lot of distributors, and the shelves are still empty. So kind of speak to kind of what both these David and Rachel spoke about. Rachel, the M&A activity, a lot of the new or increases in business or debt needs is coming from M&A activity where there's an increase. The company's grown or it's sold, and they've outgrown their bank, so they're looking for a bank that can write a bigger check, right? And so at UMB, we've got a unique kind of ownership structure. Even though we're $34 billion, we're still family controlled as a bank, so we can be really flexible when it comes to that. So a lot of what I'm seeing is new business coming in, where the other banks just can't handle it anymore, and the companies are maybe not ready to be in a multi-bank structure yet. From the working capital piece of it, having a lot of distributors, that type of company in my portfolio or our portfolio, we're seeing reductions in inventory because you can't get it fast enough. And when you can, the end users are telling the distributors, hey, if when you pay the PO, I'll give you 50% cash or more up front. So they're financing it for my clients. And so we're seeing a lot of that happen.
Yeah, there's a lot of different ways for not only the suppliers to help with our clients from a supply chain finance perspective, but certainly we've stepped in to help as well.
And personally, I mean, you talked about new cars. We bought a new car this year, and I found it online, the car that we ended up buying in May. On paper, this is what's gonna get built. So it wasn't even through the factory yet. And I put in a down payment. It was exactly what we wanted. I put down the down payment, and I can get it back if I didn't buy the car. But when it came in, okay, you got 3 days to come and look at it and buy it. Mm-hmm.
Wow.
Full MSRP. Mm-hmm.
What was that, Ferrari? What number is that?
I drive nice cars.
Okay, yeah, Lambos, sorry. So.
There is one thing that I think we should touch on when you're talking about inventory financing that we as bankers have to be cognizant of, is that yes, we understand the needs of our clients, but depending on what industry you're in, if you're looking to finance inventory in general, banks don't like to finance inventory reliant facilities. So hopefully there's a good AR base to supplement the inventory. If you're looking at only inventory, what your bank or your banker is thinking is, how do we make sure that we do this the right way? Because I know I did have a recent credit request on the table where it's this exact situation, in that we know that inventory is tight, so we want to go and scoop up all this inventory so that we've got it, but there's the risk of inventory obsolescence. And so as a banker, that's what we're thinking. How do we protect ourselves that I haven't just lent money on $10 million of inventory today that's only worth $1 million tomorrow? So as you start to have these working capital needs, that's also what the bank's going to be thinking about, and that's what you should be thinking about when you're talking to your bank and negotiating, is how do you make sure that it's equitable to both sides of the table?
Absolutely. So I don't think we have any more polling questions, but I know we're going to be coming to the end here to hit the happy hour here, but with all these happenings in the last 24 months, how have your institutions positioned itself to respond to the middle market? And this is kind of an open question to everybody, so whoever wants to answer that first is.
So for us, we're not a technology firm, and we are one of those archaic banks. So we have invested a lot in our technology.
We'll edit that out.
Yeah. Please, if my boss is listening to this, you didn't hear that. But we have invested quite a bit. In fact, our CEO and our new to be CEO were in the office, or in our market, and we were talking about this, that we've invested a ton of money in our platforms, stuff that you won't see, right? So it's our underwriting loan platform, which is boring to all of you, but it really makes it helps us make the sausage internally much easier. So it hopefully makes you much happier. Our treasury platform has been upgraded and is soon to be rolled out. So there's a lot of technology, I think, that the bank, quite frankly, has done from Bank of Texas. And then on top of that, we know that there's, as we've been talking about, pent-up demand in the marketplace. So we've done our best to try to hire and retain our employees. But as you guys are dealing with, it's a tough market out there to find the right person that fits the right culture and can do the job and do it well. And so we're trying our best, and some still slip away because the grass is always greener, but we're trying to keep that really clean in-house.
Rachel?
I think for us, we want to make sure that we're relaying the message that we've been here, we've always been here, we were here during the pandemic, and we're here to support you post-pandemic. And just to make sure that we're making our clients aware and the market aware that we've continued to be here to support our clients previously, during, and after. And I think in general, every bank tries to have that message and that mentality. I don't think it was as prevalent during the pandemic as it was maybe during the financial crisis, where you literally had had banks like unable to fund their facilities for their clients. We haven't really seen anything like that in the market, but I think as we kind of approach our middle market, we just want to make sure that we've conveyed the message, and I think we've done a very good job of letting them know that we've been here and that we've listened and we've heard them, and that we're here to help them as best we can as we move forward.
Yeah, to close the loop on the PPP, topic, a lot of that for banks was, we went into this and was, okay, how are these gonna interfere with our, additional debt, covenants and things like that in our existing loan documents, and we as an institution decided, you know what, we're not gonna worry about that. We're gonna get our clients what they need. So, how did we position ourselves? Well, by taking care of our clients like we're supposed to, right? So you can either have really mad clients or you can have really happy clients. So I'll take the latter, every day of the week. And there's nothing better than closing a sale by saying, hey, before you decide, if you'd like to talk to one of my existing clients or somebody that used to be a client, happy to get some folks on the phone for you. And if you need more than one, happy to do that. So that, that's a great way to position. But we're also well positioned, as a bank, to be creative, flexible on structure, to win new business, right? So we understand we still have to earn it. Lastly, I would say, is our model. Someone like myself I do business development. I lead and manage the underwriting process, and then I manage relationships too. So as a business owner or CFO, the person you built a relationship with and hopefully grew to like and work well with is the same person that you will continue to work with, down the road into the years to come.
Well, with that, I did actually forget a poll question. I suppose I should ask it because of your CPE credit. So if by a poll in the room, is the supply chain disruption impacting your business better, worse, or about the same as it was 3 months ago? So for those that are in the room, does the supply chain disruption impact your business? I can't imagine that a disruption would be a better scenario, but has it been worse for your business? Yes. Okay. Well, I think they posted it before, so we kind of know what they're talking about online. Well, listen, guys, thank you for being panelists and members of FEI and sponsors of FEI. As a banker and as colleagues, I'm very proud of our industry and what we've done and what we've been able to accomplish during this time. It's always the fact that we have to prove ourselves during crisis. And I think between now and all the other crises that we face, that our banking industry has stepped up again. And so for those that are in the audience, thank you for being here. Please reach out to your panelists for any questions. Oh, so we do have some time? Okay, very good. So how does that get handled? Is there a mic of some sort? Kendall? Project, okay, and I'll try to repeat it.
PPP2 versus PPP1. One, fog and mirror, you got a loan. Two, during the latter part of two, it shut down. And I don't know if y'all had any experience with clients or customers. Did you have any of that? Because I heard a lot of stories.
So I'll take that first.
Can you repeat the question if you're going to answer?
Oh,
if you got it.
I probably can't repeat it.
Okay. So the second round of PPP, what were you seeing in comparison as compared to PPP1?
It was
Was there a lot of more availability, no availability, more difficult, not as difficult?
There were a lot of folks that said, even if I can get it, I don't want to mess with it, because it was such a headache for a lot of folks. It was, but the banks had all their systems in place, and it was a lot easier process if you did. It was all pretty streamlined. So a completely different scenario. The thing about round two that kind of I could never really get my arms wrapped around was to qualify, you had to have a year-over-year revenue had to be less than a prior year.
25% decrease in revenue.
A decrease in
on a
revenue.
year-over-year basis.
But you could have been more efficient, more profitable in that same quarter, right? It didn't matter, it was only the revenue. So if you did all the right things and you ran your business the right way and you cut costs, then you really had a a double win there, because you got free money and you got, and you had a better operating business too.
Didn't experience any of that with all the T's crossed and I's dotted and everything. Because I talked to several that said, we had one that didn't, and there was no reason. So
Yeah.
I just wanted to see that as something you all saw.
I personally didn't. I don't know, maybe we should talk about this bank offline, but no, it was much more streamlined. So I had significantly less clients, obviously, that applied for it. The few that did, just the application and approval time turnaround was meaningfully faster, yeah, on PPP too. So I'm sorry, I don't have any hiccups like that.
Yes, sir.
Just really quick, as a forward-looking thing, what are you seeing as possible threats to this recovery or clients as they go into this recovery? It's always kind of a tentative period, I know, it's been there a few dozen times, but anyway, what are you seeing as risks? Liquidity, interest rates, underwriting?
Inflation is the biggest risk, hands down. Almost every company, whether it's via their input or wage, they're in some sort of inflationary environment. And the only thing that they're gonna do to respond to that is raise prices, which is going to push that inflationary environment onto the consumer, because we're already experiencing paying more. So, I don't see that calming down in the market. In fact, I see more disruption to the supply chain, in that I think it's going to continue to present this rising cost environment, which is going to continue to increase this inflationary environment. So that's probably the biggest thing. And then just in case you don't have enough to deal with, we also have the LIBOR cessation going on. So if your bank hasn't talked to you about that, anybody that's on a LIBOR-based credit facility, that is going away, and you're gonna have to change your index.
I would say, just to add to that really quickly, is just interest rates, to your point. I applaud the Fed and the Treasury for what they did. I think they propped up the system really well this time. I think the financial crisis caught everyone flat-footed. And I think they learned from those mistakes and they swiftly stepped into action. The issue is, in my opinion, is that they've been meddling inside the markets for so long now, through the bond purchases. I mean, if you look at the Federal Reserve's balance sheet, it's just massive with the amount of assets that they have on there. And so how are they going to, curb their spending and increase the rates? I know those guys are much smarter than I am, so that would be my concern, is as long-term, how much has the stimulus actually fueled the economy versus have we seen real growth? So that'll be interesting, in my opinion, to see how everyone kind of comes through that. We have one right there in the middle, Dean.
Sir.
You mentioned inflation, and I think a lot of us have seen inflationary pressures build inside the economy, and yet the government reporting doesn't seem to capture it. Do you have a feel as bankers for whether you can rely on the government reporting, or are you left to try to glean your own feeling of inflation out of the economy?
Oh my, that is such a loaded question.
Mark.
Yeah.
Mark, you want to take that one?
David tosses to me. The joke was, before any hard questions will go to David, I'd say, just look at the prices for anything that you buy, and that answers your question. But, what comes out of the government is not a question I can answer.
I would agree, quite frankly. I mean, what you as a consumer are out there buying, and as a business owner or a CFO are purchasing for your businesses, you know what that real inflation is. Regardless of how they do or they don't massage that information in the reports that come out of the Fed, the reality is you're still having to deal with it. And like that steel company I was mentioning, they're having to deal with it. A paint company, they're having to deal with trying to figure out how to get enough paint in their shops right now. So absolutely, I think that inflation's real. I think it's here, regardless of the numbers that we all hear on whatever news stations we like to listen to.
And my clients are having to deal with it too, and they really would like to have better information.
Yeah.
Well, if that's it, then thank you all and enjoy the rest of the evening.
Okay, before we do the mad dash out to the open bar, just a couple of housekeeping items real quick. I do want to thank our panelists and our moderator here, especially given that today is Columbus Day, which is a banking holiday. Uh-oh.
It really is.
Yeah.
Yeah.
Were these the same bankers that didn't do the PPP round 2 loan? Yeah, okay. Okay, we can talk about that later. As a reminder, everybody's name tag, you have your CPE form, the little yellow form. Remember, if you want CPE, fill it out, turn it in. Just a couple of quick announcements. You'll hear some of these at dinner as well, but the Career Management Networking meeting with FEI is going to be on October 19th. From 5:30 to 8 p.m. Look at the calendar for that. We have 2 SIGs coming up. That's manufacturing and energy on 10/21 and 10/27. These are virtual still until we get back to in-person. And our next monthly chapter meeting is on November 8th. So thank you all very much. And once again, thank you to the panelists and our moderator. Thank you.
Thank you.